We're going to win so much, you may even get tired of winning. Too much winning. We can't take it anymore. Mr. President, it's too much. And I'll say, no, it isn't. Please, too much winning. We can't take it anymore. Mr. President, it's too much.
Good afternoon.
The market has hit extreme fear. So most of us have probably felt like this over the past few days. I know I certainly have. Did the market previously hit a state of euphoria? Well, in my opinion, there were very few undervalued stocks or buying opportunities. Now we've got huge uncertainty. Almost everything is falling. Most are panicking. But in times like these, it's important that we, yes, you and I, take a step back to evaluate our positions, because that is actually what's in our control. For those of you who don't know me, I'm Alex, and I've studied some of the best super investors of all time to bring you this investing philosophy today. I'm personally aiming to beat the market. I tend to be fully transparent with my investing portfolio, so continue to watch my videos if you want to keep up. But essentially, my goal is to beat the market. And when I refer to the market, I mean the S&P 500. The S&P 500 averages over the past 20 years about 8.5% compound annual growth rate. Bonds at the minute, well, just less than 5% compounded annual growth rate. And I'm aiming for about 13% compounded annual growth rate. Now, that's a very respectable level. Most hedge funds can't actually beat the market, so this is going to be a real challenge for me. But as you can see from this graph here, the difference between 8.5% and 13% is huge. This is a graph showing you what happens to £50,000 invested over 30 years. You can just see that the 13% is just way higher. I mean, you're generating near to what 1.8 million, whereas the S&P 500 only would have made you about 500 and something thousand. But to beat the market, we first need to stay in the game and avoid game over. Here's a few examples of some people who entered the game and lost it all. This guy's lost 1 million in the stock market. He's lost 100k, not just play money to him. This guy's crying over here saying he wants his portfolio back to where it started, losing 160k, and he needs to make it by September. We do not want to put ourselves in that position. And as easy as it sounds, whilst you've got money, you'll be surprised at how easy it is to actually lose money in the stock market. This bottom one's just sad, so I'm not even going to read that one. So the thing we need to understand about large setbacks is that loss and gains are asymmetric. If your stock goes down by 25%, you need to gain 33% in order to break even. If your stock goes down, if your portfolio goes down 50%, you then need to get 100% return in order to get back just to where you started. So a large loss really will set you back very far. Now, luckily, stock market losses don't actually happen very often. 1 in every 2 years have a setback of about 10%. 1 in every 4 years has a setback of about 20%, which is then called a bear market. Only 1 in 10 years have a setback of around 30%. And then only 1 in 20 years have a setback of around 40%. You can see here all of the market corrections and their dates and just how often a bear market comes around. So not very often, but it will happen. It is inevitable. It will come at some point, but we want to limit our losses during that time period. So how do we limit our losses during that time period? Well, we need to avoid unprofitable companies. Here is a great example of a wealth destroyer. Rivian Automotive, they're an electric car company. As you can see on the right, they are absolutely losing money quarter by quarter. At one point, I think, they're losing around $2.5 billion per quarter. And you've probably already noticed by now the correlation between them losing money and their stock price. I mean, it just drops straight to the floor. So avoid unprofitable companies. Now you can see what happens when we actually do avoid unprofitable companies. This is a graph of the Russell 2000 index, Russell 2000 index in blue, and the pink line is the Russell 2000 index when you remove all of the unprofitable companies. So you actually get a really attractive return. Believe it or not, actually 60% of the Russell 2000 index is unprofitable. So yeah, make sure you take out the trash for my American viewers, or rubbish as we'd say in the UK. We also want to avoid extreme valuations. Now, I hate to get Palantir involved in this, but it's a prime example at the minute in the market. And I know I'll probably get a lot of hate for it, but it is what it is. It's a great company, Palantir. It's just trading at a ridiculous valuation. Its price to earnings ratio is 1,133, or it was 1,133. It's fallen since then in the pullback. Its price to sales ratio is 62. So why do I say to avoid extreme valuations? Even though I think Palantir is a high quality company, why would I not invest in it based on its valuation? Well, this is due to what is called multiple compression. Essentially, the graph here shows you earnings and terminal value. On the left, we can see that the terminal value is 7 times the earnings, or EBITDA. So what happens during multiple compression is that the stock price falls as the earnings are still growing. So the terminal value on the right, you can see, is now lower, but the earnings have still increased. Now, multiple compression usually happens during a bear market. It will also happen to a fast growth company when that growth slows down, just because investors are now pricing in less of a future for the company. Now, the preferred investment that we want is multiple expansion. So if we find a company that's trading at 2 times earnings and then it moves to 7 times earnings, then we're going to make more money on that. The price is going to increase a lot and there's more money to be made there. Now, just going back to Palantir, this is why I believe that Palantir has an extreme valuation. The red line on the screen there is Palantir's price to sales ratio. So that's just their price to revenue, essentially. And the black line is all the other fast growth companies in the S&P 500. All these other fast growth companies have a price to sales ratio of around 25. And then we've got Palantir sat all the way up at about 62 at the minute, which is just bonkers. Now, I think that multiple compression is highly likely for Palantir. When that will come, I don't know. But it's not just Palantir that I'm warning about. Anything that you think has a extreme valuation, you should probably stay away from. Now, this is an easy one. Avoid high debt. A great example of this is Bed Bath & Beyond. You might have heard of them. They quickly went out of business and went broke. There was a bit of a cult following for Bed Bath & Beyond. But for any investor with half a brain cell, you could see that they are absolutely tanking money on the right. They're losing money every quarter, and their debt was in the billions, whilst they were losing billions every year. We need to, during market periods like this, keep turnaround stocks to a minimum. Now, Fiverr was a lesson that I learned really early on. I actually followed a YouTuber into this purchase. I think I bought around $50. Luckily, I didn't have much money invested in it at the time, but it now sits at like $24. So I think I lost about 300 quid at the time. So that was when I started investing, like my first couple months into investing. And that just goes to show you that just because a company used to be worth something doesn't mean that it's going to fly back up to the previous peak. It also taught me not to follow random YouTubers into purchases without my own conviction. So now we know what to avoid. What should we actually be doing? Most of these super investors are passive and active investors. So what that means is these investors will hold a certain amount of their portfolio in ETFs in the overall market, such as the S&P 500, and then they'll have a certain portion of their wealth in individual stocks. This allows investors to achieve market-beating returns, but what it also does is it gives you a safety net that if your individual investments go really wrong, you'll still have a set amount of wealth in the background growing for you. So on the screen here are two approaches. The conservative approach, which is 75% ETFs, and so 75% of your wealth you have in the overall market, and then 25% you use in individual stocks. Now, this is great if you just want to maybe increase your fun in the market, stop you from getting bored. And then there's the alternative aggressive approach, which is 25% ETFs and 75% individual stocks. Now, I lean towards the aggressive approach, and that's because I feel I'm young, so I have a little bit more time to, if everything goes wrong, it doesn't matter. I'll get money back. I have time. If I was older, then, I'd have to consider maybe being a little bit more conservative. None of this is financial advice, by the way. Everybody has individual circumstances that they should take into account before investing. We should diversify and not diversify. So everyone's probably heard it before, diversification. What it does is it just protects you from a large downturn. It allows us to be wrong and not lose all of our money. All of us lose, even Warren Buffett. Buffett said at Berkshire's annual shareholder meeting, it was 100% my decision and we've sold it all and we've lost quite a bit of money. So there, it just goes to show you, you're not going to be right in the market all the time. I certainly won't be, but as long as we're right the majority of the time, then there is money to be made. But the benefits of diversification decay quickly. As you can see on this graph, the more stocks you add to the portfolio, the more similar your returns become to the overall market. The less stocks you have, the further away your returns become from the market. And this can go either way. You can lose a lot compared to the market, or you can make a lot compared to the market. So you are increasing risk by owning less stocks, but you're also increasing the likelihood of outperformance. Now, we need to limit correlation between our stocks within the portfolio. So what is the issue with this portfolio on the right? Well, you probably noticed by now that they are all related to crypto. We've got Riot Blockchain, Grayscale, Bitcoin Trust, MicroStrategy. These companies are all related to crypto. If crypto goes down, your whole portfolio goes down. Now, a better idea would be to limit the correlation between your investments so that when one set of companies drop down, you have another set that will rise up. A good example of this would be large tech really falling a lot, and we have real estate companies gaining actually quite a lot. Everyone's flocking from the large tech into the real estate companies. Position sizing is key. You can see a graph here of how as you increase the size of your largest holding, your return gradually increases before then dropping off and completely losing your money. If the size of your largest holding is between 0 and 10%, you're playing it quite conservative. You can still get reasonable returns, as you can see, if you're looking at the 10% end of the range. Between 10 and 20%, you're into that aggressive part of the graph. And between 20 and 40, you're looking at the insane part of the graph. Now, I'd like to note that you can have a position that's sized in the insane category between 20 and 40% and still get mega returns. If you look at that, the best returns are right in between aggressive and insane. That's when you start pushing the 40% barrier that it starts to become suicidal. If that company fails, you're going to start underperforming the market majorly. You might even lose a huge proportion of your portfolio. Now, your largest holding should be your stock with the most conviction. And therefore, that's why you've got the confidence to go really aggressive or insane with the position sizing. Here's an example of where position oversizing backfired. So Bill Ackman actually bought into Valeant Pharmaceuticals right at the top there. Fraud allegations surfaced and the stock started to drop. Bill Ackman, I think, actually spoke to the CEO and the CEO reassured him, and he decided to increase his stake to 25% of the portfolio. Now, this actually really backfired for him because it then dropped and he sold at a $4 billion loss, which was 20% of his fund at the time. This almost ended Bill Ackman's career, and he really is a great investor, so that would have been sad to see. But at the end of the day, he bought the wrong company and was overconfident and ended up increasing his size too large. That being said, how do we know which companies are the right companies to buy? We should be buying compounders. So what is a compounder? A great example of a compounder is MasterCard. MasterCard increases its revenue, its free cash flow consistently every single quarter. It increases it every year, every single quarter at a reasonably quick rate. Increases its revenue around 10% a year, and it's done that for the past 20 years. The free cash flow is increased around 15% per year. This is over time, this is great growth, and the stock price, as you can see, just follows the earnings. We also noticed that it could pay off its debt in 1 year if it needed to. So it's not a high debt company. In later episodes, I will show you how to identify a compounder, as well as showing you some of the compounders that I have in my own portfolio. So now we know we need to buy compounders, but how do we buy and sell appropriately? Well, here are a few rules for my investing philosophy, what I've gathered from studying large super investors. So when you're buying, we should buy only compounding machines, and we should buy when trading at a reasonable valuation. When we're selling, we should only sell when a mistake was made on the original analysis, sell when the company no longer meets the quality standards, and sell when there is a far more attractive opportunity. Now, as well as buying and selling, we can also trim a position. And we should only really be trimming a position when a compounder is largely overvalued, or when you believe that compounder is becoming too large a part of your portfolio. So now we know how to buy and sell appropriately. What should we be doing after that? Well, we just need to be patient. We cannot let emotions rule our buying and selling. We just need to be patient in the stocks that we have conviction with. Here's a quote from Charlie Munger about being patient. Rest in peace, Charlie. Now, Charlie said, "Waiting helps you as an investor, and a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that." And Warren Buffett said, "The stock market is a device to transfer money from the impatient to the patient." Now, I believe in both of these. These are great quotes from both of these men. Although we're being patient, we need to always be keeping our eye on the ball. Here's a great example of portfolio management. Dev Kantesaria bought into FICO. This graph shows the percentage of Dev Kantasaria's portfolio that FICO made up, and also the amount of shares that he owns. Unfortunately, the microphone cut out, which is really annoying considering this is a brand new microphone. But where was I? So Dev Kantesaria actually showed me some of the best portfolio management I've ever seen. So in Q2 2018, he bought into FICO, Fair Isaac Corporation. So you can see that here. He bought around 300,000 shares, which is the blue bar chart, and it made up 24% of his portfolio. He then added slightly, and then he held for a while. The FICO's price actually dropped quite a lot. This was in 2020 and 2021, at which point he started adding. He added loads. So he actually then had around 600,000, over 600,000 shares in the company. He continued to add while it was down. And then after that time, FICO, I'll show you on screen, FICO really began to rally. So the stock was going up a lot. And so it began to make up a larger and larger proportion of his portfolio. Now, as it began to make up a larger and larger portion of his portfolio, he actually began to sell little bits of it. So his first sell was in Q1 23, and then he's continued to sell it off. Now he only owns around 800,000 shares, but it's still making up a huge proportion of his portfolio. So he's obviously very confident in this, but he's been taking profits along the way, which is really good temperament and portfolio management by Dev Kantesaria. I've got to say he is one of my favorite investors. So we need to follow Dev Kantasaria's temperament in buys like this, and we need to take advantage of the fear and greed index. So this is exactly what Dev did. As the stock dropped, as everyone was fearful, he bought in more, and now everyone's been greedy. He started to sell a few shares. At the bottom, we see this graph here. Here are some of the emotions that you'll probably feel being an investor in the stock market. So I'd say that we were previously in this state of euphoria maybe a couple months ago, where everything was going up. Everyone thought everything would go up all the time. I'd say now we're probably in this anxiety and denial stage. And we're saying, don't worry, I'm in it for the long term. But we really need to take advantage of, if this dip does continue, we need to take advantage and really buy some great compounders while it dips. We need to not feel panic, depression, despondency, desperation, or fear during this time. We need to let everyone else do that. And we need to buy and just keep adding to positions that we are really confident in. But on the flip side, when we reach that thrill and euphoria stage, we need to consider maybe trimming some of our positions if we feel as if they're overvalued, which they probably will be in a euphoria stage. So all this being said, what does my portfolio look like? So this is my portfolio. It's really taken a hit over the past month. I had a total return of 12,000 at one point, and now I'm down to only 6,500. My portfolio largest position is Amazon with 16%, and then after that Uber, S&P Global, Texas Roadhouse, ASML, Salesforce, Hims and Hers Health is a recent position that I entered, and I entered it after a huge drop, but I didn't hit the bottom, that's for certain. So this was before, I think I made the purchase before the whole Trump thing, and then the Trump thing hit, and yeah, now it's dropped a whole lot more. I'm still confident in Hims and Hers. I know that in the long term, they are going to outperform. They are my riskiest buy, that's for certain. A lot of people are skeptical that they may be able to continue to compound. Then I have Netflix, Booking, MasterCard, and Visa. But nevertheless, I'm very convinced Amazon and Uber and S&P Global, all above 10%, will allow me to outperform the market in the years to come. I believe that most of these companies are true compounders and will continue to make consistent free cash flow. If you've made it this far, welcome to the channel, and subscribe if you want to see whether I will actually outperform the market.